So I would suspect we're getting closer. There are many signs taking place. Inflation's coming back. Interest rates are going higher. All the signs of things that happen before we have a problem. So I can see it coming. Not here today, but I can see it coming. But yes, I guess you could think since inflation's around the world and we have wars going on around the world, often in times like that, gold goes very, very high. I'm not smart enough to know the gold market, why it hasn't gone higher. Yes, I certainly understand why you're a bit perplexed and why you ask, but before this is over, Julia, it's going to go much higher. But if I were buying one today, as I said, I would buy silver instead of gold.
Precious metal bulls must be frustrated by signs of weakening prices in recent weeks following gold's notable 7% increase in October and silver's modest 3% rise. Gold's upward trajectory last month was primarily attributed to the surge in demand for safe haven assets, prompted by the escalation of the Middle East conflict, leading investors to shift away from riskier investments. Despite a surge in U.S. bond yields to their highest point since 2007, gold managed to rally. However, although bond yields have since sharply decreased at the beginning of this month, this has not yet positively impacted gold prices. Moreover, with global signs of peaking inflation and gold prices hovering close to their all-time highs, some investors have hesitated to purchase gold at recent levels, opting to wait for a more substantial price decline before moving. Legendary investor and adventure capitalist Jim Rogers points out that while gold is nearing its all-time high, silver has experienced a substantial decline of around 60% from its peak. In light of this, he suggests that if he were making a new investment today, he would opt for silver due to its more favorable pricing. Regarding investment choices in an environment of rising prices, Jim suggests that bonds are less favorable when prices are increasing due to their fixed interest rates, and property can be negatively affected, especially for those with mortgages, as higher interest rates could impact property values. When interest rates rise, newly issued bonds offer higher yields, making existing lower-yielding bonds less attractive, which decreases their prices. Instead, Jim suggests that real assets or commodities benefit in inflationary times. Many countries, including those considered allies, are exploring alternatives to the U.S. dollar due to a combination of economic fundamentals and changes in political dynamics initiated by Washington. While the dollar's leading edge is gradually slipping away, Washington's weaponizing its currency further fuels de-dollarization. So, as de-dollarization gains more traction, some investors might start looking at gold as an alternative to the U.S. dollar. We will present clips from Jim Rogers with The Julia LaRoche Show. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Well, I own silver, I own gold, I own lots of things. If I were buying one today, I would buy silver instead of gold. Gold is near its all-time high. Silver is down 60% from its all-time high. Silver is down a whole lot from its high. So if I were buying one today, it would be silver instead of gold. Well, it's near its all-time high. That's pretty, for people who own gold, that's pretty nice. But yes, I guess you could think since inflation's around the world and we have wars going on around the world, often in times like that, gold goes very, very high. I'm not smart enough to know the gold market, why it hasn't gone higher. Yes, I certainly understand why you're a bit perplexed and why you ask, but before this is over, Julia, it's going to go much higher. Well, if you're in a world where prices are going higher, you want to own the things that are going higher in price. And it's probably not bonds. It's rarely been bonds because bonds suffer from having a fixed rate of interest. So people don't want to own bonds when they see prices going higher. Property suffers because many people who own property have mortgages and they have to pay interest. And if interest rates go higher, it hurts their property. Even if they don't have debt, their neighbors have debt. And the people down the street have debt and they suffer. And they have to sell even if you don't have to sell. Stocks usually suffer in times like this because people can get a better returns, they think, from interest rates that are going higher. So the only thing that benefits at a time like this are real assets, commodities, call them what you will. I mean, the price of silver nearly always goes up when there's inflation. The price of rice nearly always goes up when we have inflation. So the real assets, the commodities, are usually a good place to ride it out and even perhaps make a lot of money. Well, I'm mainly looking at trying to figure out where we're going. I have a lot of US dollars in cash because I'm looking for which currencies will be the new competitor for the dollar. I have not found it yet. Washington is driving many people away from the dollar because the world's reserve international currency is supposed to be neutral. Anybody is supposed to be able to use it for anything, but Washington is changing those rules. If they get angry at you, they cut you off. They say you cannot use dollars, or they take them away from you. They confiscate them. So many people, including our friends, are starting to look for something to compete with the US dollar. I don't know what it will be. Throughout history, every 100 years or so, the world's international currency has changed. The U.S. has been on top a long time. We have problems. We're the largest debtor nation in the world. So for fundamental reasons, people are worried. For political reasons, now Washington is changing the rules. So many countries, our friends included, are looking for something to replace the dollar.
Jim Rogers posits that a consistent historical trend reveals the link between excessive money printing by governments and the subsequent emergence of inflation. In recent years, major global economies, with the United States at the forefront, have engaged in substantial money printing facilitated by their central banks. While tempting during economic crisis, this strategy is met with caution from economists who highlight its potential to instigate hyperinflation. Jim asserts that the unprecedented global scale of money printing, surpassing any in history, is bound to lead to inflation. He points out that countries like Japan have actively created significant money. This widespread practice is anticipated to yield consequences, ushering the world into a period with potentially severe inflationary outcomes. As inflation takes hold, the fixed-rate income generated from bonds diminishes in value, prompting investors to offload their bond holdings. This, in turn, triggers a rise in interest rates, setting the stage for a cycle that has unfolded in the past and is poised to repeat itself. In essence, Jim foresees a recurrence of the economic patterns, where inflation, spurred by extensive money printing, reshapes the dynamics of bond markets and interest rates on a global scale. Let's get back to the interview.
But inflation is not good. How's that for a thought? No, inflation has started throughout history when a government or anybody prints a lot of money. It has always led to inflation. It's pretty simple, the way the world works. And in the last several years, the central bank in the U.S. and elsewhere, but especially in Washington, has printed huge amounts of money. It has led to inflation, and it's going to get worse. We've never had such huge money printing in the history of the world, and it happened all over the world. Like, gosh, the Japanese and Tokyo, they're even not worse than Washington, but as bad as Washington, and it's happening many places. So we have a period, probably never before in world history, when we've had so much money printing by major economies, and we're all going to pay the price. Well, I have learned not to pay too much attention to what the central bank says. I have to listen because they do have an influence, and people listen. The one must listen to them, but no, for me, they don't have much credibility. The central bank in Washington has very, very rarely been right in its history. It was founded in 1913. It's been wrong most of the time. But Julia, remember, these are government employees. They don't know anything. They can't get a job in the real world, so they work for the government. They get a government job, and they're academics and bureaucrats. The way markets work, Julia, they go up, they correct, they go up, they correct. So we're having a correction, a normal correction in inflation numbers. Makes the central bank think, we did it, we won, we did what we were supposed to. And so people will think things are better for a while. But when the economy starts slowing down, the central bank's going to print a lot more money. Inflation is going to come back, not just in the U.S., but all over the world. No, we have staggering amounts of money printing in the last year or two all over the world, and we're going to have worse inflation. It's not over yet. So, bond prices went to the highest in American history, in world history, in fact, and interest rates went to the lowest in American history a year or two ago because they printed so much money. All that money the money's still there. They didn't burn it up after the first year or two. The money's still out there floating around somewhere. And so inflation will come back. And when you own a bond, you have a fixed rate of income, and you have a fixed income. You know that the income you're getting is worth less and less and less. And that's why bonds start going down, because everybody says, wait a minute, I'm getting 4% from this bond, but 4% is not worth what it used to be. So then people start selling bonds and interest rates go higher. And it's happened often, and it's happening again, and it will happen again. Well, yes, if you own a bond paying 4% and interest rate and inflation is 7%, every day you're losing money. And if your bond doesn't mature for 28 or 29 years, you're going to be sitting there losing money for 29 years, and most people will not be happy about that.
The future of precious metals hinges on geopolitical tensions, inflation, and changing investment trends. With countries seeking alternatives to the U.S. dollar, gold's role as a hedge against currency volatility could become more prominent. What are your thoughts on the future price movements of gold and silver? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.